Let's start out with the basic question since the election, which is we've seen this tremendous move in the markets in response to the election. What do you make of it? Is it to be believed?
Maybe I'll start. Look, I think investors got into this election day expecting uncertainty and contested election, and we got certainty. So I think that explains a big part of the rally, but also, it's the continuation of the pro-growth, pro-inflation, pro-dollar Trump reflation trade. And remember, the market started pricing this in all the way back in September, a lot earlier than 2016, when he pretty much shocked everybody. So I would say what I call maybe the first phase of reaction is probably mostly done at this point. Where do we go from here? I think the devil is going to be in the details. It's going to be in the personnel decisions. It's going to be the policy sequencing. Is it going to be the tariffs first? Is it going to be the cuts first? The magnitude of the fiscal policy, magnitude of the tariffs. So I think all of those will be critical in determining whether or not this Trump trade will continue.
So with personnel, so far we've seen State Department, migration issues, et cetera. You're waiting to hear Treasury Secretary, what happens with the Fed, et cetera. Got it. How about you, Sarah? What do you make of this big move?
Well, I think for the first few days after the election, I would describe it as if the Trump trade from 2016 and the meme stock mania from post-COVID had a baby. That was what you saw in the first few days. You saw Bitcoin, small caps, financials all rallying at the same time. So where are we now? I think markets focus on two factors, 10-year yields and market valuations. So first of all, yields have been backing up, and that's what's caused this rally to take a little bit of a pause. That's based on the expectations for lower taxes, more tariffs, and deregulation. The concern around that, of course, is what does that mean for the deficit? What does it mean for the economy? Will it cause the economy to overheat? And will it cause inflation to reignite? So what do I think will happen? We're already seeing Fed cuts getting priced out of the market. A few days ago, we were expecting 5. Consensus was expecting, not as 5 rate cuts through the end of 2025. That's already being lowered. We're also seeing broader market participation. I think that's here to stay. Areas like small caps are still at 2-decade lows versus large caps. But then valuation, S&P at about 22 times forward earnings. The last time in the last quarter century where we saw higher valuations, March 23rd, 2020, and we all know how that ended. So valuations are certainly something that are making us pause for a moment.
Yeah, but that was short-circuited by a pandemic. That's not going to happen this time. I mean, I hope. So you're suggesting stocks you think are expensive?
Well, actually, sorry, I misspoke. March 2000 was
okay.
The time we saw that, which was short-circuited by a tech bubble, actually. They all get short-circuited by something.
No, it's the pandemic just gave us all. So it sounds like you think stocks are expensive or at risk here because of what we've seen.
Actually, Trump isn't even in office yet. So first of all, a lot of this rally has been pulled forward. But I always say, the saying is markets don't die of old age. They probably die of a negative catalyst. And what's the negative catalyst in the next few months? I don't really see one unless the economy really cracks, because Trump's not in power yet, and we have to see what the repercussions and implications are of the initiatives that he puts in place. So I think there is still room for this rally to run, but we do need to be careful because of valuations. That's why we're looking at areas that are cheap. Small caps trading at that big discount. Banks, which had a multi-year rally after he came into power last time around. I think you need to be more selective, but I think just owning technology at the expense of everything else is probably not going to be a winning strategy from here on out.
But even with the huge moves in small caps that we saw, it was 6% that night. You think there's even more to go based on what we've seen?
Yeah, I think in small caps there is, because they're still trading at a pretty deep discount versus their counterparts across asset classes.
Maybe that's where we differ a little bit. Look, I agree. I think where this leaves us in terms of stocks is that I think a good portion of the returns we expected for 2025 has been pulled forward, and by any metric, I think the equity market looks expensive. But I think the real question is, does it even matter? Does that, is this a barrier for further upside? I don't think so, because I don't think valuations matter all that much for near-term returns, as long as there's not a near-term, downside catalyst. I think, like you mentioned. And also, I think bull markets tend to end with a euphoria stage where valuations move higher almost on animal spirits alone, and we're not seeing any signs of that. We're not seeing a fourth IPO market or a M&A. like a wave of M&A activity. I mean, those things are lacking right now. So I think this rally that we have seen have been more of a climb the wall of worry type of a rally. Also, there is more. In terms of positioning, I think post-election, it hasn't changed our positioning dramatically at all. I think what it did is clear the runway for stocks to move further higher. So we do have a bias for equities over fixed income. In equities, our favorite region is US, and we expect about 10% returns from now through end of next year. Our preference is for large cap stocks, actually, because that's where we think the strongest growth, earnings growth is going to come from. And I know small caps actually have been the winner of the Trump trade. I guess from my perspective, post-election moves is small caps suggest maybe there's going to be a huge fiscal stimulus that's coming, and we're going to see a re-acceleration of the economy. And that is not our base case. So that's kind of, and from a sector perspective, I think that's important. Our preference is for technology, because I think AI spending, we've heard earlier in the panels, I think it's going to stay strong. Financials also similar to Sarah. It's all the stars are aligning there as well.
Well, you were talking about that's the huge fiscal stimulus priced in, which you're not certain is going to happen. Let's talk about the long end of the yield curve, which has been, what exactly is that signaling? Is that signaling growth? Is that signaling fear of inflation? And
I
is
think
that going to be the catalyst that hurts the rally?
I think the 10-year yields have responded to both politics and fundamentals. Like, I think it's interesting that the 10-year yield was still climbing after the first cut in September, 50 basis points, because the growth data is really strong. And now, on top of that, you have the pro-inflation, pro-growth policy in the mix. And I think what's really interesting is that after the initial pop post-election, we have seen yields come right back down. So I think that's bond market's way of saying, slow down. It's still uncertain which policies will actually become reality.
I think the 10-year is basically telling us that we're worried about the last mile of inflation, that it's going to remain sticky. We've seen that today. CPI coming out at expectations, but shelter costs have been sticky. Wage inflation has been an issue going forward. And really, when are we going to hit the Fed's target, I think is going to be an issue. I did want to touch on small caps. There's 3 reasons we like small caps: the dollar, tax cuts, and deregulation. So strong dollar, I think, benefits small caps being domestically oriented versus large caps. It could be more multinational. Tax cuts, good for the U.S. consumer, more spending at home. Also tariffs, of course, more spending within the U.S., all good for smaller companies in the U.S., which tend to be more domestically oriented. And deregulation, I think, is going to make the world an interesting place, because it could open up more M&A activity, which, again, positive for small caps, as I mentioned, trading at that deep discount to their counterparts.
Strong dollar. So Trump has made clear he doesn't like the strong dollar, right? He would prefer that to not occur. He would like to push U.S. manufacturing, et cetera. Would that be, if they start to make moves that hurt the dollar, would that change your premise and your outlook on some of the sectors that you picked?
I think if you're making pro-growth moves in the U.S. and inflation is going to remain sticky and the Fed's going to cut rates slower than expected, the outcome is probably a strong dollar, because if you look at the rest of the world, starting with developed international, the European Union, it just doesn't have the growth rate that the U.S. has, because it didn't have that technological advantage that we have, and they have the same sticky inflation problem. So I think they are challenged. They're also challenged as long as China remains weak because they have a stronger trading relationship with China. We all know about the problems in China, which likely continue or get worse. EMX China is interesting because other countries like Korea may benefit as China remains in a tough situation. Mexico, I think, a bit of a wild card this time, depending on whether nearshoring means U.S. and Mexico or just the U.S. But all of that, to me, says the U.S. still has that advantage and that exceptionalism, and that means the U.S. dollar probably remains quite strong.
It's interesting because a lot of people point to Europe and say it's cheap. And it sounds like you're saying it's cheap for a reason.
I think cheap needs a catalyst always. Small caps, when I say small caps are at a 2-decade low versus large caps, I could have said that every day going back for years. So what's the catalyst? I think Trump coming into office and some of these changes to policy are the catalyst for small caps.
But I think there are things to do in Europe. I mean, I agree. With Europe, the growth is quite uneven and weak, better than probably next year. It's going to be better than 2024. in Europe, what's attractive to us is actually different than US is small caps and mid caps. So in the US, we like large caps, but in Europe, small cap, mid caps, because the profile of these companies is a little bit different. And also our view is that while we don't call a recession at all, economy in the US is probably going to slow over the next year, whereas in Europe, it is moving into the different direction, although it's probably going to be not as strong. So that's...
What makes their profile different compared to, when you say that they have a different profile compared to?
They have a different profile because I don't think we started seeing earnings growth coming already in those companies, whereas we haven't started seeing the earnings growth yet. I mean, for a good portion of last year, we were a bullish small cap. We were waiting and waiting, and it didn't come through. I think so. That's, I would say, a little bit different from a regional. And then other rest of the world, similar to Sarah, I think, China, we are more neutral, hesitant. I think in addition to the tariff concerns, you have a little bit of disappointment still around the nature of the stimulus that is coming in, not targeting as much the consumer or the property. But there are other places in Asia that we like, Taiwan benefiting from AI, India benefiting from demographics, Indonesia, Malaysia benefiting from reshoring, shifting of the supply chains. So there are other things to do, but when you put it in rank order, I don't think anything beats US.
Ditto?
I think, yes, I think for the time being, US probably will remain dominant market, but it doesn't mean we should ignore the rest of the world. There are other areas, and also outside of equities, other asset classes. We mentioned the struggle for fixed income. You mentioned equities over fixed income. I think fixed income still has some interesting pockets, like leverage loans, floating rate loans, which can actually perform well in terms of in periods where interest rate cuts may be a little bit less than the market expects. And of course, alternatives are a very important piece of investors' portfolios. I started in the industry, and for many years, the 60-40 equity fixed income portfolio was basically what clients wanted. Today, I think we're moving more towards a 50-30-20, 50% equities, 30% fixed income, 20% alternatives, which can add diversification and lack of correlation to your portfolios. Areas such as private credit, real estate, infrastructure is an area that is a top pick for us as more manufacturing moves to home, and the shift to renewable energy continues, and we have to upgrade our grids within the US. I think infrastructure is a very strong multi-year play and somewhat of an inflation hedge because they can pass through those contracts on a cost basis.
So you've talked about a lot of different ideas. What's the single best investment idea right now?
Probably what I've been talking about a lot on this panel, which is US small caps.
Yeah, absolutely, okay.
We look at everything from a portfolio context, so I think it's hard to single out one idea, but maybe I will mention an opportunity in private markets as well, since we talk so much about the public markets. Well, first of all, we like private credit. That's actually where we get credit risk more than the public markets, 11% yield. But I think prior panels talk about that, so I want to touch on private real estate. Our focus is on multifamily sector, which is exposure to demographics and the lack of single-family housing. And there are a lot of deals that have been done in growth markets like Sunbelt over the last few years, where those markets are still trying to absorb that supply. And these deals, I think, were done by maybe less sophisticated investors who made some errors and invested at lower cap rates, financing with short-term floating rate. So now you have all these assets that are really distressed, but the assets themselves are actually good in good markets, so they're becoming available at
a good price.
At good prices.
So what kind of return can you get there versus?
I think you can get a high single-digit, low double-digit return over a multi-year horizon. Obviously, you have to stick with the investment, but yeah.
What would you absolutely not do right now? What do you think is a bad idea at this point?
I think we need, just a factor we haven't talked about yet is the geopolitical risks, and also how does the next administration think about these areas where we've had these conflicts, which are unfortunately still ongoing, like in the Middle East. What does that mean for energy prices? Also Russia-Ukraine situation. I think it just makes those areas of the world very challenging to invest in, which is why we're being careful outside of the US. Other factors we're thinking about Inflation, I mentioned, I think that's probably our biggest macro risk for next year, which is that last mile, which I think will be difficult to achieve. We're also closely watching U.S. employment markets and the consumer. Consumer has been a very strong driver of this U.S. economic cycle, but it's been tilted to the higher income consumer. And so can they continue to spend in this face of inflation? I think that's been the big question mark for investors and employment markets. Just last month, payrolls came in at plus 12,000, which was a weak number. It was blamed on strikes and storms. We hope that wasn't an anomaly, but it probably tells us that September payrolls of plus 254,000 were an anomaly. So where is the U.S. employment market? Where is it going to land and come back into balance? I think these are all areas we need to closely watch to determine, where is the U.S. economy? We're all talking about how it might strengthen and overheat next year. But we need to watch to see, where is it descending to as we speak.
What risk do you see, Solita?
So what would I absolutely not do? I would not do Bitcoin, and I would do gold all day long. In terms of risk, in the that we're watching, look, like Sarah said, there is a long list of risks, from geopolitics to tariffs and inflation, everything. But I would say at the end of the day, similar to you, everything hinges on the consumer, because if we see a consumer spending pullback, there's nothing that can replace it.
It's interesting you say gold all day, but Bitcoin no, because a lot of the supporters of Bitcoin argue that there's a similar rationale.
Yeah, but the last couple of years I think has proven that it's not similar, because it's not a geopolitical risk hedge, it's not an inflation risk hedge. It's really trading more like a speculative tech stock that doesn't have any profits. So I think there's value to it, and clearly the price has moved up, so people are making money of it. But like I said before, we look at everything from a portfolio perspective, and the risk return, the volatility in it hasn't yet proven to us, at the very least, to have a place in a long-term portfolio for our clients.
I think
but you could trade it all day long.
Bitcoin's been a very volatile asset class, and for those who are concerned about equities and where they're going, Bitcoin's probably has 5x the volatility of equity. And I think the fundamentals are tough to understand, like where is it pricing versus its fundamentals. But I do think the reason it's had the strong rally in the last week or so is because that headwind of regulations that Biden had on, was talking about with Bitcoin, and that would have been expected to continue if Vice President Harris won, has been alleviated with the Trump coming in. And I think that's why Bitcoin has had its strong rally, and that could continue because of that headwind being removed.
Yeah, if you had imagined the counterfactual, let's say Democrats had won as decisively, they had been talking about a 30% excise tax on energy that is used to produce crypto, right? So you have a completely different scenario than what could have happened. So that would be a natural reason why Bitcoin would rally, even if you don't like it particularly.
Right, just like banks, when any asset class has a large overhang removed from it, like regulations, that asset class is going to rally, and that's what we've seen with banks, with cryptocurrencies.
And do you have clients who are very interested in it? Do you get asked a lot about Bitcoin still?
I think clients are interested in anything that's making volatile moves or volatile swings.
So it's an asset class, right? That's what makes it fun.
It's an asset class that you need to be, aware of, on top of, and make your decisions in terms of what's your risk tolerance. And if you, think about your risk tolerance, that's with any asset class, equities, fixed income alternatives, our alternatives and private asset classes paying you enough of a yield to overcome their liquidity issue. It's just across the board, from risk tolerance from low to high.
Yeah, we have a wide spectrum of client base, and there's of course some that certainly ask about it, maybe invest themselves, definitely buying the ETFs, but again, for a portfolio, for a longevity portfolio, I think we have been able to explain the rationale why it doesn't have a place in the kind of portfolios that we're managing. And if they're, trading it on the side as a complement,
have at it.